Markets hitting a speed bump recently following multiple up weeks for all major averages. The Dow Jones Industrial Average looking to bounce back from its worst day of 2024, but it's a little changed right now. With the market whiplash, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Pernas researcher, co-founder Deiya Pernas, along with Mahoney Asset Management CEO Ken Mahoney, are joining us now to discuss. Thank you guys so much for being here. Deiya, I want to start with you here. How should people sort of think we're sort of up and to the right for a while pretty consistently, and lately things have gotten a little bit more volatile, especially now that the catalyst of earnings season is over. What's going to be the next catalyst, and which way is it going to take us?
Yeah, I think that as far as the recent volatility, I think it should just be put in perspective. If you look at just broader sentiment, if you're looking at pricing volatility like the VIX for the index, that's still quite near 10-year lows. So if you zoom out a little bit, the volatility is still quite low. And the market is actually, when you're looking at that broader perspective, quite complacent. So I think that if there's any sort of risk, it's a risk of complacency. The broader index, if you look at investment grade spreads, if you look at high yield spreads, all of those are near 10-year lows. So from my perspective, at the index level, there's been a complete departure of recessionary fears from broader market pricing. And if there's anything investors should be worried about, it's complacency at the index level.
Deiya, we have the indices at or near record highs. Well, we just had a big sell-off, but they're still pretty close within a few percentage points. Do you think the markets have gotten too complacent here? Well, how are you viewing things?
Yeah, I think, look, the market's trading at 21 times forward, and it's somewhat typical of late cycle that you see large cap quality do quite well, and that's what we've seen this year. And if you drill down into some of the smaller cap names, the small cap index right now is small cap value is flat on the year. Small cap growth is up a little bit on the year. So the other smaller type names have not participated. And if you drill down into different subsectors like quick service restaurants, like luxury goods, like staffing companies, like real estate related sectors, a lot of those are struggling. So if you look at it holistically, there's some areas of the market where cracks are evident. But again, at the index level, I think there's a lot of complacency. So I think investors should take a more holistic view and realize that, look, maybe large cap's done really well. Maybe I should rotate in some of the other, different type sectors, maybe some of the traditionally lower quality stuff, because there is some value there.
Well, Deiya, we'll get back to you on what some of those specific ideas are, but I want to get Ken's take on this idea of complacency, and specifically, Ken, through the lens of valuation, which I know is something you've been doing some work on.
Right. So at first, again, it kind of sounds like a cliche, but seriously, we went from April showers to May flowers. And, the Bears really had a good opportunity. I mean, it really was the perfect storm, Russell Crowe movie, where, you had higher interest rates, you had the Federal Reserve nonstop, higher for longer, higher for longer. Oh, missiles flying around in the Middle East. And the Bears only got, about 5-6%, and the bulls took over again. I think the reason why it's happening is we're getting a very strong tailwind with earnings and earning estimates going higher. We saw what happened this week, one example in the video, but there's a lot of examples this earnings season, especially in technology. So we don't need to be near airlines and autos or retailers or some of these other ones that are mentioned. We don't need to be in those industries. We're in the fast lane. We're growth managers. We accept a bumpier ride in the left lane. But that's where all the CapEx spending, that's where the excitement is. The multiples can expand when we have this type of opportunity. And I know there's a lot of similarities with the 1990s and stuff. But that was like eyeballs and clicks on valuations. These are real contracts. These are real $20 billion contracts with Meta or $20 billion contracts with Tesla. So to me, you can actually justify the valuations when you have top line growth like this, and you still have a 2 or 3 year window for CapEx spending.
Deiya, let's go back to you. Just a couple picks here. If you love big tech, we can talk about that. But if you have other areas of the market, we'd love to hear that too.
Yeah, look, I think the best portfolio has a little bit of everything. There's no reason to let dogma take over and focus only on one part of the market and have blinders on. There are large cap quality names that we really like. Ken, he mentioned Meta and some of the huge spend that's going into GPUs and the data center infrastructure that surrounds them. And I think there's incredibly rational reasons to be bullish there. But as far as we try to look at different areas of the market where there is value. And right now, where we are seeing value is some of these smaller cap names that have a little bit more debt, that have variable rate debt, And they don't have quite all the levers that the large cap companies have to pull in order to smooth out earnings through a cyclical type environment. So I think that if you're looking at some of the small cap names, there could be opportunity. I know we're bullish on several that I can discuss, but yeah, that's where we're at with our portfolio.
And what about you, Ken? I mean, you said you're a growth guy. Where are you seeing the best potential for growth right now?
Look, we still see with NVIDIA. I mean, they really haven't come out with the blockbuster helmet that's going to come out later this year. And look, I hear how expensive it is, but again, a lot of that's PE, which is rear view mirror. Forward PE, which is looking ahead. You're finding yourself 37 to 40 for NVIDIA, and quite frankly, that's where it's historically last 10 years. Sometimes it goes higher, sometimes it goes lower with great earnings. What's expensive to us is companies like Nike that have forward PEs of 35, who are going to have 1 to 3% top line growth. Again, we also like Meta. We also like Apple. We think it's going to be a huge upgrade cycle with AI. Also, they're buying back $110 billion worth of shares. That gives some type of support. Microsoft, all the verticals you get, and AI on top of a cloud. And Amazon, obviously, that was kind of a sleeper this quarter. Those are really strong earnings, particularly in advertising. I don't think a lot of people put attention to that. I think for Amazon, it's mostly about cloud. It's the retail side, we trip over your boxes and Prime members, but $12.8 billion in a quarter for advertising. So that's very expensive real estate on their site. So again, we still like the big tech. We like these companies because, let's face it, Meta has 3 billion, Facebook has 3 billion daily users, Microsoft 1.2 billion clients, and for Apple, 2.2 billion devices. So we don't like small cap, we like large cap because they have wide moats. And again, little $5 here, $10 here for an upgrade is substantial to the bottom line for those companies that have these huge amount of customers.
Well, you do $3 billion times a couple of dollars, and you got a lot of $1 billion. Deiya, I want to get to something you're talking about in your notes. A lot of these pandemic companies really took a beating. I'm sorry, pandemic darling companies took a beating in 2022, along with the general market. They've either had trouble raising cash, or they've just been kind of thrown out, as you say, baby with the bathwater. Can some of these companies be rehabbed? What would that look like?
Yeah, as you alluded to, there so many companies came public in 2020, 2021, or even early 2022, and it was just a huge money grab. There's a lot of euphoria. IPOs were being priced very extremely, and business owners were accelerating their time to market. And what that resulted in is companies that didn't quite have the full-fledged communication departments, even the full-throated business models that the street typically likes to see for publicly traded companies. And their earnings are just way too cyclical. They're not linked. Like Wall Street really likes to see companies that are growing revenue very steadily year over year, even quarter over quarter. So that's what Wall Street really likes to see. These companies, they're just too small and even a bit too flimsy, but that doesn't mean they're not real companies. I'll make a concession. A lot of them aren't, and a lot of them shouldn't be publicly traded companies. But they are some, I think, jewels in there. And one of them that we really like is Remitly, that went public in 2021. They're a cross-border digital remittance provider. We think there's well over 100% upside from these levels, best-in-class technology. And the company just doesn't quite know how to digest their business model. And they're still acting like they're a private company themselves. They don't communicate the right information with the street. And so there's still a lot of work to be done there. But it's a real business with a real business model.
All right, we're going to have to leave it there. We got the closing bell coming up. Deiya and Ken, thank you both for your time.
Thank you.